This is Justin reminding you to drink your OJ for today, Tuesday, March 21st, 2023. You'll need it. We're going to talk about something very relevant to today's news and something that I, as a progressive, absolutely fucking love. Regulations. Yeah, I guess I need to remember that this is a new channel and I am a new face, so I should point out that was a joke. Now, which part? The progressive label or the pro-regulation stance? Well, both. And neither. And before you leave, just because you think I'm fucking with you, please allow me to assure you that I would never do that. That's a lie. It was a test, actually. I will absolutely fuck with you, because that's going to keep you on your toes. And in this news environment, it's either agility or death. If people think they can get a handle on who you are, they may want to put you in a box that helps them neatly sort the world in their heads. This is a delusion. It's a comfortable delusion, so I don't blame people for engaging in it. But it is not what Drink Your OJ is about. To figure that out, you'll just have to watch. Hi! That's how we start a show around here. Or, I guess, damn it. Let me start over. This is Drink Your OJ on March 21st, 2023. Over the past couple of weeks, we've seen the failure of multiple significant banks, starting somewhat quietly with the shutdown of Silvergate Capital a couple of Wednesdays ago, then brought very much into focus by Silicon Valley Bank, or SVB, a bank which catered specifically to venture capitalists and startups, making it the second largest bank failure in U.S. history and the largest failure since the 2008 crisis, as of Friday, March 9th. Shortly afterwards, on Sunday, March 12th, regulators closed Signature Bank after a deposit run, the third largest bank failure in the U.S. history. And meanwhile, Switzerland's central bank loaned $53.7 billion to Credit Suisse after the bank disclosed material weaknesses in its reporting. First Republic Bank, a San Francisco lender that specializes in private banking and wealth management, received a total of $30 billion from 11 of the largest banks in the United States in a move coordinated partly by federal officials. So, sort of a pseudo bailout from their peers. And things don't really appear to be stabilizing, or at least there seem to be many indicators that additional banks will fail. So we're going to talk first about what exactly is going on right now and how bad things really are. Here's a hint: your net worth may affect your perspective. We'll then discuss some potential outcomes and solutions going forward. Hint, again, your net worth may affect your perspective. But if you would be so kind as to go ahead and take a quick moment to scroll a little down, give that like button a tap, that'll help folks find my lovely videos. And if you actually enjoy my lovely videos, please subscribe to the channel. You can probably see that there are changes underway. I ask that you please judge things going forward based on the content I'm putting out as Drink Your OJ. That other character, he belongs somewhere else, and we're working on finding him a proper home. So before I start getting too deeply into everything, I want to point out that I've included links to my research in the video description. So you don't have to take my word for anything. You can easily find my sources of information just below this video. And I do this both to help you be as informed as possible. I may not cover a certain subject in as much depth as you'd like, but the information was still published so you can read it for yourself. And also to enable you to hold me accountable. If I take anything out of context inaccurately, explain something incorrectly, or just misstate a fact, you can easily source check me and put a comment below the video reasonably demanding a response. Of course, politely, always politely, and I will be more than happy to oblige. I promise to do my best to avoid mistakes, but I'm still human, and I'm doing this content creation stuff in addition to my regular full-time work. But since my goal is to spread information and awareness, I want to make sure everything I share is accurate. So pointing out inaccuracies helps me do a better job for everyone else, and that makes you a hero. Now, housekeeping out of the way, let's talk about banks and their filthy money. I mean that literally, seriously. Have you seen what's on physical cash? Wash your hands if you ever touch that stuff. Most people are generally familiar with the SVB failure at this point, so I'm not going to spend too much time on that specifically, but we will watch a video that goes into depth for a couple minutes to really explain that situation. Just to address a point that a lot of people have brought up, depositors at any FDIC-insured bank have protection guaranteed by the federal government for up to $250,000 per account, more or less. Now, there's some specifics with regards to account types, but basically each pot of money gets $250,000 of insurance policy. If you have more than $250,000 in the same pot, your money is at risk. There are a million ways to manage this. We'll talk about that later. But because of its unique relationship to Silicon Valley tech startups and VC money, as well as its reliance on long-term government bonds, which pay a higher yield than short-term treasury bonds, that really got SVB into trouble. So, a fun financial term we're going to use is duration risk. SVB used long-term government bonds to back its deposits due to their higher yields relative to short-term bonds. But Long-term debt is sensitive to changes in interest rates because as rates rise, even so-called safe assets like government bonds can decline in price. So when the Fed began raising interest rates, it saddled SVB with losses that forced it to try to raise fresh capital so they could have enough cash on hand to cover deposits. But once word hit the street that Silicon Valley Bank, again a centerpiece in the startup VC world of tech, in which a larger than average number of businesses rely on loans from investors to operate, only becoming profitable after scaling to a certain size. Once word got out that SVB needed cash, this spooked depositors and caused a bank run that led to its failure and ultimate intervention by the FDIC. Now, in a move aimed at promoting faith in the banking system, the federal government declared that the FDIC would replace funds lost by depositors at the bank with account balances larger than the typically insured FDIC $250,000. The bank's investors/shareholders were not bailed out. Rather, the depositors themselves were bailed out. So that is a critical fundamental difference between what took place with SVB and what happened in many cases in 2008. The bank initially was determined not to be too big to fail, and it indeed failed. While the bank was indeed allowed to fail, depositors at the bank were fully bailed out. And remember, SVB's customer base was specifically filled with high-risk, high-growth startups. Those are the clients they sought out. For Signature Bank, it was cryptocurrency millionaires or billionaires. And while the FDIC only insures deposits up to $250,000, there are myriad ways in which an entity can ensure that more than $250,000 is protected from a bank failure. The various ways you can protect your money from bank failures include the FDIC insurance that we've been talking about. FDIC insures deposits up to $250,000 per depositor per insured bank. So this means that if your bank fails, you'll be reimbursed up to $250,000 for each account you have with that bank. If you have more than $250,000 to deposit, you can consider opening multiple accounts with different banks to ensure that all of your deposits are covered by FDIC insurance. CDARS, the Certificate of Deposit Account Registry Service, CDARS. It's a program that allows you to invest in CDs with multiple banks while still enjoying the convenience of working with just one. CDARS enables you to deposit funds in excess of $250,000 and have them spread across multiple FDIC-insured banks. And this can help ensure that your deposits are fully insured. Treasury bonds. Investing in U.S. Treasury bonds is another option to consider if you want to protect your money from a bank failure. Treasury bonds are backed by the full faith and credit of the U.S. government, which makes them a safe and secure investment. However, it's important to note that Treasury bonds have lower yields compared to other investments, such as stocks or corporate bonds. And then, of course, there's private insurance. Some private insurance companies offer deposit insurance that goes beyond the $250,000 offered by the FDIC. However, these policies can be expensive, and it's important to carefully review the terms and conditions before purchasing deposit insurance from a private company. As is always the case with anything financial. Now, some economists have provided analysis predicting that more than 186 U.S. banks may still be at risk of collapse. As a result of the Trump administration rollback of numerous post-2008 regulations that were put in place to avoid a repeat crisis, many banks that would have been subject to additional government oversight have been allowed to avoid enhanced capital requirements like those put in place by the Dodd-Frank Act in 2010. Specifically, the centerpiece of a law passed on a bipartisan basis in 2018 raised the too big to fail threshold from $50 billion in assets to $250 billion, 5 times as large. This enabled the so-called mid-sized banks like SVB to avoid regulations that were designed to prevent banking failures like those experienced in 2008. What is happening as a result of this? Let's first take a look at a conversation from the Majority Report crew that explains in a little bit more detail the SVB failure.
Well, I mean, the important thing to know about the Silicon Valley Bank collapse and the subsequent actions is that everyone was at fault. And when everyone's at fault, that makes it supremely easy for individual people who were at fault to point to the other person who was at fault, right, to deflect blame. So you can go right on down the line and see failures here at pretty much every level, finger pointing going on at every level of this. But it is absolutely clear that the 2018 deregulation bill, which I call the Crapo bill because it reflects both its author and its content, Mike Crapo, the senator from Idaho, that bill absolutely was laser targeted at the very regional banks that are experiencing crisis right now. The stadium banks, as I called it, that aren't big enough to be a global systemic financial institution. However, they are big enough to get naming rights to a stadium. These are the banks that are in this wheelhouse right now. And the biggest things in that bill helped those banks. It did two major things. One was increasing the threshold for enhanced prejudicial regulation from 50 billion in assets to 250 billion in assets. There's that part of it. And
let me just ask you a question about that though, because wasn't the theory that, and I think like, Powell's argument was like, these are not, I don't know exactly the term of art. These banks do not constitute a systemic risk, right? Like they're not big enough to constitute a systemic risk.
Right.
But if that's the case, why did the country come to a standstill for 3 days? Like, everybody's like this.
Well,
like, definitionally, how could that be?
And indeed, to bail out the depositors, they had to invoke a systemic risk exception to the rules because Dodd-Frank kind of banned bailouts, but there was this exception. They had to say, oh, these guys are a systemic risk, and that's why we have to do this. There are all kinds of examples of banks of this size whose failure leads to a systemic problem. And so this was never, and by the way, if it wasn't for several Senate Democrats, this bill would never have happened. Mark Warner, John Tester, Heidi Heitkamp, Joe Donnelly, they co-wrote this with Crapo.
Right.
And they are completely 100% responsible for this happening and are completely unashamed about it because Warner, even now, is going on television saying that this was a good bill. And Tester is out, doing the blame game, pointing the finger at something else, raising the threshold. The second thing it did is it invited the Fed to deregulate even further. It changed one word in a statute, a statute known as the tailoring rule. And this rule says that the Federal Reserve has the ability to tailor rules to what they see as the risk involved with that bank. And they changed that from the Fed may tailor rules to the Fed shall tailor, see if they were going to change the rules. And that's exactly what they did in 2019. They tailored the rules to weaken them even further on the stadium banks, on the banks between $100 and $250 billion. And now we can start talking about the Fed in this, because not only did they roll back some of these rules, which was discretionary, it was discretionary deregulation what they did. They had the opportunity, they had to look to tailor the rules, but they didn't have to do it the exact way they did. And what they did is they went in the most deregulatory direction. So what we learned today, there was a Bloomberg piece, San Francisco Fed trying to cover their ass. They put out this thing that says, oh, well, we sent them what are known as matters requiring attention. We saw that the bank had this interest rate risk because they put all their money or a lot of their money into long dated securities that did well at low interest rates. And when the interest rates went up, the value of those securities went down. They didn't hedge that risk in any way, balance sheet. And then the bank also had this huge flight risk because most of their deposits were over $250,000. All of them came from the same industry of people who are on Slack with one another. So they didn't have 30,000 depositors. They had like 9. And the San Francisco Fed, according to them in the story in Bloomberg, knew this and sent them these stern letters that said, you might want to take a look at this. You have no risk management on your interest rate. This is basic banking 101. You haven't accounted for the potential change in interest rates. And the bank did nothing. And the San Francisco Fed didn't follow up. They just sent letters.
Well, wasn't that because they are so woke? Because they're from San Francisco? Right?
It could be.
And they're infected with wokeness.
The bank has no risk management whatsoever. They didn't have a chief risk officer for 8 months. They had a really time bomb portfolio, and they didn't change it. The supervisors didn't make them change it, didn't ask them to do anything out of the ordinary, gave them, you sent a few letters, but did nothing beyond that to actually follow up. So they're at fault. The reason that these enhanced rules were put in under Dodd-Frank is because they knew that the examiners don't really do anything. Rules. There are all kinds of rules that were put in there. The Fed and Congress got rid of them. So you have Congress being the problem. You have the Fed at the top level being the problem. You have the San Francisco Fed being the problem. You have Silicon Valley Bank being a problem. And you have depositors that are such dumbasses that they have millions, hundreds of millions of dollars sitting in a bank that it's
only
public
insures
knowledge.
250. Yeah.
And it's public knowledge that they have a problem. There was a guy who was a short seller who was pointing this out months and months ago. And there was a story in the Wall Street Journal like half a year ago. And it's basic cash management of any business to not put all of your money in a place where you could lose it.
Okay. All right. So listen.
Yeah. So quick explainer goes into pretty good detail there to really understand what happened over at SVB. So how do we make sure this doesn't continue happening? Well, legislation has been introduced by a group of Democrats led by Katie Porter of California's 47th electoral district and Elizabeth Warren, senator from Massachusetts, that aims to repeal the centerpiece of the Trump administration's 2018 law. However, not everything is sunshine and rainbows. There are some real fundamental problems, even with the legislation that was passed in the wake of the 2008 crisis. The Dodd-Frank Wall Street Reform and Consumer Protection Act, that is, Dodd-Frank, was enacted on July 21st, 2010. And this law both granted additional responsibilities to the FDIC and created new agencies like the Consumer Financial Protection Bureau, CFPB, which was charged with protecting consumers against abuses related to credit cards, mortgages, and other financial products. Dodd-Frank is regarded as one of the most significant laws enacted during the presidency of Barack Obama. And studies have found that the law has improved financial stability and consumer protection. But this may have come at the cost of some potential economic growth. In addition, some argue that while Dodd-Frank has improved existing regulations, there are still gaps that exist in the regulatory framework. So to try to get a better understanding of what exactly Dodd-Frank is, let's take a look at this presentation from the Bipartisan Policy Center and Brookings Institution. So we've got the impact of the Dodd-Frank Act on financial stability and economic growth, presented by these fellows, Martin Neal Bailey and Aaron David Klein at the University of Michigan in October of 2014. What they did is divide Dodd-Frank's provisions into 5 sets. Essentially, clear wins, clear losses, costly trade-offs, didn't go far enough, and too soon to tell. So it explains, different ways that regulators can make the most of Dodd-Frank, how Congress can make Dodd-Frank better, talks about clear wins, increased capital being one of them, a new resolution process via a single point of entry from the FDIC, the creation of the CFPB, restrictions on Fed and FDIC crisis authority, on the other hand, were seen as a clear loss. And it goes into some of the details about why they feel that is. They feel similarly that the Volcker Rule and Lincoln Amendment are costly trade-offs. So essentially, if you read through this, they say that, the Lincoln Amendment addresses the same core concern as the Volcker Rule. So having both in place is costly and unnecessary. And then they look at areas where Dodd-Frank didn't go far enough. And one of those things that they mention is regulatory consolidation. So, prior to Dodd-Frank, we had fragmented regulatory structure with gaps and overlap. But after Dodd-Frank, there's still some overlap, although some gaps were filled. So they offer, some ideas for streamlining that resolution. They feel that the FSOC did not go far enough. And the Office of Financial Research similarly did not go far enough. And now, too soon to tell is all of the various capital rules. Now, again, this is a report from 2014. So while it was too soon to tell in 2014, I would argue that it's now been told. And we know that these capital rules do make a difference in ensuring large banks do not fail. Again, they're imperfect. It still might have been possible for SVB to fail even under the Dodd-Frank regulations, but it would have been far less likely. I highly recommend taking a look at this piece. It's really broken down into easy to understand language. They present a lot of good information. Dodd-Frank's provisions were divided into 5 sets. The majority of those considered too soon to tell are now proving to have been, while imperfect, better than nothing. But of course, better or worse has a lot to do with your individual perspective. And while cheering for bank failures seems like an arguably sociopathic position, if one stands to personally benefit from additional bank failures, it's hard to argue with that same person enjoying the current news. So, in the wake of the 2008 financial crisis, Bitcoin was invented, and it was specifically designed to act as a hedge against fiat-backed banks, one over which no individual or indeed any nation-state could ever have control. Now, 2 of the 3 bank failures that have taken place in the United States so far have been at banks primarily associated with cryptocurrency money. One would think this would lead to a decline in market faith for cryptocurrency assets. Yet, Bitcoin, whose price sat just below $20,000 the morning of March 10th, had risen to over $28,000 by March 19th, representing about 28.5% growth in under 10 days. And in that same period, the total market cap for cryptocurrency grew from just over $961 billion on March 10th to more than $1.2 trillion by March 19th, a market growth of approximately 21.5%, with information courtesy of CoinGecko.com. So, will fiat-backed banks propped up by a national central bank, virtually capable of printing money, ever be able to be stopped from becoming too big to fail? Or is the capitalist quest for profits and growth always going to result in a certain number of banks, perhaps with a significant percentage of the total economy on their own books, making risky investments and essentially gambling with taxpayer dollars after seeing time and time again that even if the worst comes to pass, the government will swoop in and prevent an actual financial crisis? Perhaps the fact that roughly 1 out of 4 of all the dollars in circulation today have been created post-COVID, meaning it took only a few years for all that extra cash to apparently corrupt the portfolios of potentially hundreds of banks, representing hundreds of billions, if not trillions of dollars of wealth. Now, granted, this was partially attributable to the Trump-era law passed with bipartisan congressional votes, specifically 2018's Economic Growth, Regulatory Relief, and Consumer Protection Act, the law that increased the size of a bank subject to oversight by regulations spelled out in Dodd-Frank from $50 billion in assets to $250 billion in assets. And it turns out that SVB fell under that threshold, even though it was the nation's 16th largest bank. Now, keep in mind that nothing in Dodd-Frank addresses some of the issues we mentioned with SVB's portfolio. namely the duration risk associated with long-term debt. The use of risk-weighted capital allowed SVB to build a portfolio ripe for failure that still somehow satisfied regulators. Obviously, that is problematic, to say the least. But in an interesting twist, someone has accepted a $1 million bet that the U.S. will not enter hyperinflation, but on the side of hyperinflation. In other words, he thinks hyperinflation is going to happen, and that within 90 days, Bitcoin will be up to $1 million. I don't know what's going to happen. We'll see. It'll be interesting, especially for the people involved in making the bet. So what should you do specifically to protect yourself against bank failures or hyperinflation? Well, first, I should state I am not a financial advisor, and I do not give financial advice. But for the sake of entertaining a hypothetical, I would suggest that you adjust your approach based on how much faith you have in the dollar versus Bitcoin. Personally, and again, this is not advice, if anything, it's a disclaimer, I'm going with Bitcoin. Not because I really think the dollar is going away, but I can certainly see it potentially losing value relative to Bitcoin. Do I expect the price of one Bitcoin to be $1 million in the next 90 days? Not really. Wouldn't it be nice? I mean, obviously not just for those who purchased Bitcoin, but also because it would imply that there has been more exiting of fiat and entering Bitcoin. And this is a trend that, in my opinion, is a good thing that should continue. Now, on the other hand, if you are extremely scared of Bitcoin or something, I don't know, I'll never understand people who still don't seem to get it. But for y'all, I would say, as a thought experiment, again, not any sort of advice, maybe consider parking as much as you can in short-term treasury bonds for a few months, something highly illiquid that will help protect against the dollar through potential digital devaluation. Of course, always make sure to keep enough cash on hand to be able to handle your expenses for ideally a couple of months if you're suddenly unable to access your bank account. Or again, you could just get Bitcoin instead. But again, that's not advice and should just be taken as my opinion because that's all it is. To quote the dude, it's just like my opinion, man.
Yeah, well, that's just like your opinion, man.
So what to take away from all this? Well, I would point out the fact that basically everyone involved is fully at fault, despite all of them pointing fingers at each other. And meanwhile, given that this is the biggest bank failure since 2008, Bitcoin seems to be doing exactly as it was designed to do. Something in which I've had faith for a very long time, but this is the first time it's actually being demonstrated in the United States. Similar things have happened in other places in the world, but we're now seeing it in the US. As someone who despises banks, loves Bitcoin, owns Bitcoin, and has continued buying Bitcoin weekly-ish for the past 5 or 6 years, I kind of like the idea of cascading bank failures, followed by shitloads of money being printed, followed by hyperinflation, and ultimately hyperbitcoinization. I think all it really takes is for the U.S. to declare that it will accept Bitcoin to pay taxes. And I think that would be very bad news for the dollar. But I'm certainly not an expert. Hell, half, if not more, of everything we just talked about is shit I just learned over the last few days for the sake of researching this video. So I have no doubt there are plenty of people smarter than me on this topic, and I hope that if they come across this video, they'll take the time to leave a comment. But even if you're not a genius economist, I'd love to hear your thoughts anyway. So please bring on the comments, good or bad. The only thing I ask is that people not be intentionally toxic or try to engage in bad faith discussion. It's not something I'm going to tolerate. I deal with it enough on Twitter. So if your comment contributes nothing of value, go ahead and keep it to yourself, or else don't be surprised when it suddenly disappears. I plan to keep this channel civil. So now that I can take off my dad hat, I'm thinking about making my next video focused on something Web3 oriented. Definitely a different kind of think than my standard fare, but something that I hope will be helpful and interesting to a lot of people. Now, if you liked this episode, please make sure to tap that like button, subscribe to the channel while you're down there, as I was saying before, and also consider leaving a comment. I'd love to foster positive discussion in here from people of all types of viewpoints. So with that, I think it's time to wrap up the episode. As we go to the outro, I'm going to go ahead and do a fat-ass dab of this blueberry purple kush hybrid, because I aim to normalize cannabis use for both medicinal and recreational purposes throughout both the United States and indeed the world. We'd all be better off if the people in charge would just fucking blaze down on the reg. I mean, I base that on nothing but my own imagination, but good luck convincing me otherwise. Love y'all. Take care of yourselves. Take care of each other. We'll see you soon. I'm going to do my dab now.